Welcome, traders. In today's video, we'll discuss the 5 deadly O's of trading. Overconfidence, overtrading, overleveraging, overexposure, and overriding stop losses. Deadly O number 1, overconfidence. Most people tend to believe that they are above average. For example, researchers have found that 73% of U.S. drivers claim to be better than average, which is statistically impossible, because exactly half would be better than average. Because of this natural human tendency, our judgment is highly susceptible to overconfidence bias. Overconfidence often leads traders to take excessive risks, neglect proper risk management, and make impulsive decisions. This can result in substantial losses that could have been avoided. Then, we ought to consider the question of how to avoid overconfidence. Start writing an investment journal now. Maintaining a record of your investment decisions, the reasons behind them, and their outcomes can help you evaluate your past performance and identify areas for improvement. Set realistic expectations. Remind yourself that no one can predict market movements with absolute certainty, and be prepared for the possibility of losses as well as gains in your investments. Continuously educate yourself. Stay informed about market trends, new investment opportunities, and relevant research to keep your knowledge current and help counteract overconfidence. Moving on to our second deadly O, overtrading. Overtrading occurs when traders execute too many trades, often fueled by the desire for quick profits. This can lead to high transaction costs and emotional exhaustion. You will know if you are overtrading. If you close a trade for a loss and deep down you feel like you shouldn't have taken the trade, then you're guilty of overtrading. For example, you constantly monitor the market and feel the urge to trade multiple times a day, even when your strategy calls for a few carefully chosen trades per week. You overtrade by executing numerous low-probability trades, racking up transaction costs, and causing emotional stress. This excessive trading leads to losses that could have been avoided with a more disciplined approach. Your emotions may have been the cause of the aforementioned action. Letting your emotions get to you regarding your trading performances is dangerous. When it comes to trading, the head, not the heart, should be in charge. On our channel, the playlist of trading psychology can provide you with more advice. When you suffer a large loss or a series of losses within a short span of time, you might be tempted to revenge trade. So how do you avoid revenge trading? Here are some tips for you. Exercise self-awareness. Investors who are aware they may be overtrading can take actions to prevent it from occurring. Frequent assessments of trading activity can reveal patterns that suggest an investor may be overtrading. For instance, a progressive increase in the number of trades each month may be a telltale sign of the problem. Avoid day-long trading. Trading is not a 9-to-5 job, and spending the entire day trading will not necessarily bring you more profits. Trading requires you to dedicate a significant amount of your spare time to offline learning. Moreover, trading is not something you can excel at just by spending more time or when you have very urgent needs. So, choose the time of day when you are most efficient for your trading activities. Set a weekly trading limit. At the beginning of each week, set 3 limits for yourself. Once you reach your set limits, you must stop trading until the start of a new week. You can use any number you like. However, you'd better not set more than 3 limits per week. Deadly O number 3, overleveraging. In Forex trading, leverage means that with a small amount of capital in your account, you can open and control a much larger trading position. The advantage of using leverage is you can magnify gains with a limited amount of capital. The disadvantage of leverage is that you can also magnify your losses and quickly blow your account. As for overleveraging, it involves using borrowed funds to amplify your trading positions. While it can magnify gains, it also significantly increases the risk of substantial losses. For example, you have a $10,000 trading account and decide to use 10x leverage to control a $100,000 position. While this can amplify gains, it also magnifies losses. A small adverse price movement wipes out your entire account, even though the market eventually moves in the direction you predicted. Overleveraging resulted in unnecessary risk and a substantial loss. How to avoid overleveraging? Traders should use leverage conservatively and avoid taking on positions that exceed their risk tolerance. A general rule of thumb is to use no more than 2% of your trading account per trade. Maintain adequate capital, probably the most important one. Traders should maintain adequate capital in their trading accounts to cover potential losses and margin calls. This means having sufficient funds to cover their initial investment and any additional funds required to meet margin requirements. Monitor your trades. Traders should monitor their trades closely and use stop-loss orders to limit their losses if the market moves against them. They should also be prepared to exit trades if they are not performing as expected, rather than holding on to losing positions in the hope that the market will turn around. Our fourth deadly O, overexposure. Overexposure happens when a trader's portfolio is heavily concentrated on a single asset or a few correlated assets. This can leave you vulnerable to significant losses if that asset underperforms. For example, you have invested all your capital in a single technology stock because it's been performing exceptionally well. You fail to diversify your portfolio and become overexposed to the technology sector. When the sector experiences a sudden downturn due to regulatory changes, your portfolio suffers massive losses, illustrating the dangers of overexposure. To avoid overexposure, diversify your portfolio across different asset classes and industries. Diversification helps spread risk and can protect your investments from unexpected market movements. You can invest 20% or 10% of your allocation in high-yield, high-risk assets and 90% or 80% in low-yield, low-risk assets. Here are some high-yield, high-risk assets and low-yield, low-risk assets that you can invest in. High-yield, high-risk investments, emerging market stocks, small-cap and growth stocks, high-yield bonds, commodities, and futures. Low-yield, low-risk investments, savings accounts or money market funds, government bonds, blue-chip stocks. Our fifth deadly O, overriding stop-loss. A stop-loss is a predetermined price level in a Forex trade where a trader instructs their broker to automatically close the position if the market moves against them, limiting potential losses. Overriding stop-losses occur when traders ignore or adjust their predetermined stop-loss orders in the hope that the market will turn in their favor. This can result in catastrophic losses. For example, you set a stop-loss order at 10% below your entry price to limit potential losses. However, when the trade starts going against you, you panic and cancel the stop-loss order, hoping the market will rebound. Instead, the market continues to decline, and you incur a much larger loss than you originally planned due to overriding your stop-loss. To prevent this costly mistake, always set stop-loss orders based on your risk tolerance and trading plan. Stick to your strategy, even if emotions tempt you to override your stops. Create a straightforward trading strategy. Fixed stop-loss. Set a stop-loss of 20 to 50 pips. If the market moves in an unfavorable direction and reaches the specified loss level, you will automatically exit the trade to limit potential losses. Using market-specific turning points as stop-loss. Use key turning points or support-resistance levels on the market price chart as indicators for stop-loss. When the market price approaches or breaks through these key points, consider them as stop-loss levels. For more information about support and resistance, you can watch our last video, Master Support and Resistance. Use mental stops alongside physical orders. In addition to setting physical stop-loss orders with your broker, also maintain a mental stop-loss level in your mind. Commit to not adjusting or overriding the mental stop-loss under any circumstances. Practice patience. Give your trades time to develop and reach your predetermined targets or stop-loss levels. Avoid making snap decisions when market fluctuations occur. And there you have it, traders. The 5 deadly O's of trading: overconfidence, overtrading, overleveraging, overexposure, and overriding stop losses. These pitfalls can wreak havoc on your trading journey if not kept in check. By avoiding these deadly O's, you can greatly increase your chances of achieving long-term success in the markets. Thanks for watching. If you liked this video, be sure to hit that subscribe button and turn on notifications so you never miss a video.